Margaret, what about the idea of these stocks being tired? It's no newsflash here that these stocks at times have been considered defensive, and that's why the money has continued to go there. But is there any thought that it's time to take some profits in what has been a pretty darn good run for a lot of these stocks?
Well, as it relates to the technology companies all referenced here, between what John's comments and Steve's comments, I would absolutely agree that they, one, can be defensive by the nature of their balance sheets, cash, not extensive debt, the growth rates that, demonstrate that these companies can have less than cyclical as it relates to the economy, the economic, contraction that we're having here right now. And that, coming out of this, maybe the stocks will harvest some, stay here and take some of those gains that they had and led the market here. But in my mind, these are strong companies with the balance sheets that can get us through this crisis. And also, once we get more consolidation in this market rally, potentially lead us coming out of this as well.
Yeah, Josh, let's not forget ServiceNow. They crushed it. Qualcomm, good stuff from Qualcomm, too. Has this just shut the door a bit on the conversation of a rotation, as Weiss was suggesting at the top of the show? There's been a lot of talk that these stocks are tired. It's time to move into cyclical names, play for the rebound. Maybe not.
Well, Steve Weiss correctly points out that we do have these 2 or 3 day rallies in value, and people get really excited because it's like spotting an oasis in the desert. Unfortunately, that oasis always ends up turning out to be a mirage. The mean reversion that some people have been waiting 12 years for fails to arrive or doesn't last long enough for it to be actionable or for anyone to feel better about that side of the equation. The best trade over the last 10 years, and that trend is being accelerated in this environment, the best trend over the last 10 years is to look at a very non-traditional metric. And the quants hate when I say this, but if you just weighted stocks in your portfolio based on how people are spending their time and what they're actually using and doing all day, you've made a fortune because you're in names like Apple and cloud names like Microsoft, Google, and Amazon. So, that has been the trade. And then when you think about the stay-at-home version of our regular lives, look at what Azure announced look what Microsoft said about Azure. 59% growth in cloud, 59%, and they're already the biggest or the second biggest. So it's just incredible what the growth they're seeing in that business. Look what Google said on YouTube, 22% growth in subscriptions. I don't know anyone that has a subscription to YouTube, but I guess that's a thing. They made over $4 billion with it. And then 33% growth in YouTube ads. So these are trends that have been in force for a decade. They're accelerating now. So it makes it really hard to say, I want to have a portfolio that underweights these names. It's really, really hard to do that.
Yeah. So, Joe, how does it all set up then for the way we should look at Apple? I mean, Apple's different than these companies. Sure, there's a services arm, and we know about that. But at the end of the day, you're trying to sell phones. And China's a big part of your business, and you rely, as a consumer-facing brand, on the consumer to continue to consume your product.
Yes, and I think that's all correct. And each of one of these names, they're core holdings. Absolutely. The characteristics that define them as cash-rich companies. And what is also very compelling about these companies is that they have an ability for shareholders to pay a premium for their stock price in the absence of buybacks. We're going to be living in a COVID-19 post-investment environment that's going to be void of the amount of buybacks that we experienced in previous years. So that's why they're core holdings. I will say, though, they can be tired, and they have been tired in the last 5 days. You're seeing today Microsoft barely trading unchanged. The last 5 days, you've got Amazon basically around unchanged. That doesn't mean you're getting out of these names. I think what you're looking to do is understand that they are core holdings, and then to reference Josh's comments as it relates to the Russell and small caps, universally in the last 3 days, all I heard was everyone applauding the fact that the Russell and small caps were moving higher, and there seemed to be a clamoring towards that trade. I think a lot of us have talked about being very judicious in stepping into that trade. So I think where we are right now, Scott, the most important thing is not how much cash you maintain, but what your risk exposure is to the market. And unquestionable, with the S&P at 2950, you have more risk than you did 3 weeks ago, and you're going to have to measure mitigate and account for that risk and go accordingly.
So, Josh, just about everybody out here owns Amazon. So to the point of Joe making, the S&P, given where it is, that adds maybe a level of risk, right, just given the move itself. What about that for Amazon? How do we all feel about Amazon going into this number, knowing the move that it's already had? Josh, I begin with you.
Well, technically it looks great, but they always look great, right before a big move lower, because everyone's in when they look great technically. So fundamentally, is any company on earth better positioned for this moment than Amazon? Probably not. But does anyone disagree with what I just said? Is anyone not aware of that? Probably not. So could it be overcrowded? Could it be, quote, due for a pullback? Absolutely. If you've been a long-term holder in Amazon and you've stuck with it quarter after quarter after quarter, there's always that one quarter during the year where they stick their thumb in your eye and they throw a whole bunch of expenses in that you weren't expecting, and you get a pullback in the stock. But if you've not been in it, you should be rooting for that. Or if you're not in it in size and you want to be bigger in Amazon, that's the quarter that you wait for all year when they do that to you. But Jeff basically is operating at a scale and scope that no one else on the planet can match. He can enter new businesses at will. He can exit things that didn't work out at will. Nobody criticizes. And the company's got a great position in terms of its financial flexibility. So, yeah, you could say it's gone up a lot, but then my retort would be, yeah, obviously, look what they're doing.
Sure.
It should have gone up a lot.